Yum Brands Incorporated is one of the largest quick service companies in the world by number of restaurants, with more than 55,000 units in more than 155 countries. The main brands of the company, KFC, Pizza Hut, and Taco Bell, are leaders in their market segments. The company develops, operates, franchises, and licenses its chain of restaurants that prepare, package, and sell a range of competitively priced products. Let's move on to the company's financial performance. Here you need to pay attention to the data after 2013, I will explain in more detail a little later. You can see that the company's income is approximately at the same level. Net profits are also in the range from $1 to $1.5 billion. The company's assets have decreased. You can see that the company's debts have doubled. The company also steadily pays dividends and resolutely buys back its shares from the stock exchange. Before I rate this business, don't forget to subscribe to my channel so you don't miss my future videos. I rate this business 0 out of 10. To be honest, at first this business surprised me with its results because it brought its investors more income than the S&P 500 index itself. They made the right decision to concentrate on their three main brands because there is no need to have many restaurants that below average quality, and McDonald's is a great example of this. In general, I was satisfied with almost everything in this business, except that in 2012, about 42% of all the company's profits came from China. For me personally, it was a big risk if I would buy this company, and the company itself understood that China's policy could significantly affect their business, and I was interested in how exactly Yum would solve this problem. In 2016, they finally split their business into Yum China and the rest of the world. You can even buy shares in the Chinese sector. To be honest, this is almost the worst decision I have ever seen in my life. Think about it, for more than 10 years the company invested money, took on debt, spent time on training team members, developing the network, advertising the brand, only to then simply take and tear off half of the network. The company was supposed to get money from its investment, and as a result, it all went to waste. Diversification of business makes sense only when a company operates in multiple sectors and cannot develop all of them at the same pace. In such cases, a smaller company that focuses its attention can be a positive indicator for investors. Unfortunately, the situation here is quite different. So coming back to the company's financials, I hope I've explained clearly why the company's revenue has halved since 2013. Now the company's share can be bought for about $134 and its capitalization is close to the level of $38 billion. After 2013, the company's assets decreased significantly and the debt increased significantly. If you look at the shareholders' property, you can see negative values, which unfortunately leaves little positive for the company. So, buying a company for $38 billion and adding $14 billion in debt, the total cost will be $52 billion. If we subtract $6 billion in assets, it turns out that we are overpaying $46 billion for the business. The company has an average net income of $1.4 billion, which does not increase significantly, suggesting the need to dispose of it. In my opinion, this business cannot be an investment option in any case, even though it has powerful brands, so I will not buy shares of this company. Subscribe to my channel so you don't miss my next videos.